Good evening, ladies and gentlemen. Welcome back. As I only had to say the word politics and people just lose their minds. We're going to talk about some of the political debates, but I also want to roll back a little bit. There's so much going on in the investing world. There always seems to be, whether it's the dividend increases from SCHD. We're going to take a look at some clips with Cathie Wood and their thoughts around Tesla and where I think she ruined herself a little bit. I don't know if you saw the Meet Kevin, Cathie Wood, and Ross Gerber little debate thing there where I kind of lost respect for a few people in that conversation. But we'll kick it off first and foremost here with a fun little comment, because there's this massive debate still, as like every video in this technological revolution. Are we in the AI bubble? Is this the equivalent of the dot-com bubble during that era, right? And I saw this nice little quote from Everything Money. No, from what are these guys called again? Man, I'm blanking so hard. I just got up, so you got to bear with me here, folks. The All In podcast. I think that's what these guys are here with, Shamath Palpatine and all these guys. But they had a great clip that I think highly resonates, because I made a video and somebody said, I disagree. I just disagree with the NVIDIA analogy. The company is 3 to 4 generations ahead of any competitor. AMD and Intel can't even produce the equivalent of Blackwell. Basically, in my quote, I'm just saying that when you have drug dealer-like margins, competition's not that far off. And this year, almost every tech company announced their own AI chip. How good those AI chips are, how much supply slump they make up for, I don't know. I'm not a tech genius. I'm not buying NVIDIA. I don't buy SMH. I'm just buying the S&P and I get some NVIDIA exposure. I'm a moron. I missed a huge, massive rally, which I would have got out of far too early, as I usually do, because I don't trust it. But hey, I think there's a really good comment in here that I think resonated so well with me in this weird tech nuance evolution.
Of course, means OpenAI, which was valued at $86 billion, could,
because they're talking about OpenAI coming public and what the valuation would be on it. But just take a listen.
IPO at some point. What are your thoughts on this? We saw the revenue numbers are crushing it. Any thoughts, Chamath, on OpenAI IPO? Is that a possibility in your mind?
I mean, it makes so much sense for them. So I think they should do it as quickly as possible. We are in the first inning of what should probably be an enormous tectonic shift in technology. And I think, if anything, whoever wins in the first inning usually isn't the one that's winning by the 9th inning. And so I would encourage anybody that's winning right now to monetize, get secondaries, take money off the table as fast as possible, because the future is unknown. And the more disruptive the technology is, the more entropy there is, which means that there's going to be more changes, not less. And again, I would just look at search as an example. I would look at social networking as an example. When you look 20 years later, the people who captured all the value were not the ones at the beginning who everybody thought was going to win. And so I think if it plays out similarly, it's important for the people that are in the lead today to recognize it's too early, and they should monetize their perceived success as quickly as they can to the largest magnitude possible.
In other words, you might be OpenAI, you might be MySpace. Yeah, grab the bag if you can.
Grab the bag. So what is it called? Secure the bag. Sorry, secure
the bag. Yes.
Coming from Shamath, that's real rich, because the dude literally became a billionaire grabbing the bag on companies that I think are quite ironic, actually. And I think, but to a publicly traded company, I think there's huge unprecedented value in that statement. And considering Shamath brought Palantir public, I think it's so important to understand that, like, Palantir came public at a time where it was so incredibly easier to capture that bag and that value for just hype companies when the market was just pumping, right? And the only reason, and I don't think this is like a dispute, I think this is just the way it happened, was that they diluted the living hell out of shareholders. They raised so much money coming public via SPAC during this era here, and that gave them so much cash that when the stock tanked, it tanked probably below its even intrinsic cash value, right? Like, I mean, well, maybe not to that extent, but I mean, it dropped 77%, and now it's pretty much back up there, right? Like, it recovered pretty dramatically, but there are very, very, very few companies that came out of this that are actually back up 290, like actually survived this. And the only companies that survived this are companies that just had an insane amount of cash, because the higher interest rates benefited them so well. And half these initial rallies in Palantir were because they were net capital on interest income. I mean, it didn't really have much to do with the revenue, but now the revenue is catching up a bit. It's starting to contribute to their net income and all this stuff. But a good chunk of their income is just from interest, which is from that massive amount of cash. that they secured that bag on. But it kind of still comes back to that point of, I can't wait to see how the shift happens and what AI companies are actually left to survive and who's going to hold on. But whoever holds on to this stuff is going to be worth a lot. It's just that it's so immaterial today, I think, to the bottom line. And then I get this comment here, which I think is interesting. How is the Canadian economy not exploding? Now, I'm referencing this into this Kathy Wood video that I watched, but it was really funny because it just says, how's the Canadian economy not exploding? I'm in Halifax and people are spending dollars like they're printing it themselves. Houses are selling. Costco is busier than I've ever seen it. Buying cars, traveling. Where's the recession? So at the end of the day, I think we get diluted by what we see around us. At the end of the day, it really just comes down to GDP, because GDP is the true defining factor to the goods and services sold within a country. And they're still in a good place. I mean, they're still growing, right? So it's not saying that the economy isn't growing. And I just felt like I lost so much respect, not that I had any really to begin with Meet Kevin or these guys here. But what an interesting debate, man. But if you want to just get I'll play a couple clips here, because just listening to these guys go back and forth really shined a light on I think Ross Gerber, if you don't know this guy, he runs a hedge fund. I think he's a yammering baby who just doesn't know anything, or I don't think has ever run a real company in his life. And then you have Kathy Wood, who has done a fabulous job at picking stocks and selling them and doing all the stuff at the wrong time. So, I mean, both commendable for their own stupidities, but there's a lot of interesting shit in here from the Trump Biden. I'll just show you this little clip and we'll kind of skip through it. I'm not going to watch this 27-minute ordeal, but hey, there's some fun clips in here.
Invalidated the pay package
so
because
judges are now in
This is just them rambling about the pay package because Ross Gerber did not agree with Elon's pay package. It just shows a little bit of light into the insanity of these two.
charge of corporate compensation.
No, it's not about corporate compensation, Kathy, and I think that's the misperception. It's about corporate governance. And Tesla has a board that is not independent. And it is required by the NASDAQ and Delaware to have an independent board. And what the judge had said was that the package was not negotiated fairly with the board. See, the issue I had and why I voted against it was I thought it would be much more productive for them to do a new pay package than to regurgitate the old one that was shot down.
They could not, ISS said the same thing. Why didn't they cut the pay cap? You couldn't do that legally in this.
Well, you can retroactively add
But
compensation
that's
from the past.
beside the point. I shouldn't even have.
So this is such a ridiculous debate, and it's so funny because Kathy Wood, I kind of have the same opinion as her here. Is like, how do you revert someone's pay package when everyone and the shareholders already agreed to it? It's like you have Boeing CEO over here getting a 40% raise against the backdrop of Elon, who's fighting just to get paid.
Have countenance the point because I just don't agree with it. He did it. We've voted once again. The shareholders have voted
Twice for this.
and I don't think court and we voted knowing full well all the governance issues you think were an issue. But if they were an issue, they were an issue back then, and you shouldn't have voted for it.
Exactly.
No, I don't. It's not what I think. It's what the judge in Delaware thinks, and that's why it got
Really?
invalidated.
Oh my goodness.
So what's happened now is it's going back to the judge in Delaware, and just because we revoted for it again doesn't necessarily make it valid either. So that was the problem, is that we're still dealing with this.
You know what's been great about this whole time? Andrew Ross Sorkin on CNBC, and we used to be on the other side of Tesla regularly. He is with us on this. I think this is un-American.
It's really heated in this conversation, and I think it's a brilliant conversation to be had. And I think I'm not even American, and it feels un-American. But speaking of American or not, I think Kathy Wood blew her whole image up here. And again, I'm probably going to get a lot of heat for this because I'll give you my 2 points on the debate, because we're going to watch some clips that are a little bit probably out of the realm of what you were expecting to see. But this is just.
You just announced that you're going to be voting for Donald Trump.
I'm not supposed to be announcing anything. All I'm saying, you asked
it was best for the economy.
On economics, he definitely is one of the best
that you're
in
going to
history.
vote for who would do best for the economy.
That's who I tend to vote for.
Okay.
My
Okay.
compliance department tells me I can't say who I'm going to vote for.
So you're voting for Trump?
No, I would never vote for Trump, but that has more to do with morality than anything else.
Yes. I
not
agree.
from an economic point of view.
I just,
How do you
I don't
think?
want to tell you all my Trump stories.
How about this? How
I
about
have
this?
actual stories.
Since this is about money and economics,
I grew up in the Apprentice era.
so did Stormy Daniels.
Once again, I don't want to get into stories that I know about,
So,
but he's not my candidate.
how about for the economy?
I think for the economy, I think Joe Biden's, one of the most progressive economic policies that I've seen in a long time, whether it's FTC, what you brought up.
Anyways, she ended up saying because of her kids, she's going to vote for whoever's the best, economic track record, which was Trump. And honestly, this is the hilarity of it because, I'm not from the US, so I don't want to get too heated about this. We have our own political things to deal with. But honestly, and again, I kind of go back to that All In podcast. They made a lot of really good points about this, that the only people that won during that debate was China, Russia, North Korea. I can't ever in my entire life growing up seen something just so deplorable and so like this. How is this being allowed in your country? It's like, and then I was going back and I was finding these TikToks and I was like sharing them with everybody. And I'm like, you remember when political debates were actually like respectful? Like, you remember when your parents had respect? like I'll show you a few clips because some of these are great. I'll watch maybe one or two of them.
This is 2008, man. A middle-class tax cut to 95% of working Americans, those who are working two jobs, people who are not spending enough time with their kids because they are struggling to make ends meet. Senator McCain is right that we've got to stabilize housing prices, but underlying that is
You have the morals of an alley cat.
Give you a minute, sir.
I didn't have sex with a porn star.
Americans, workers are the best in the world. They're the fundamental aspect of America's economy. They're the most innovative. They're the best. They're most at best. We're the best exporters. We're the best importers. They're most effective. They are the best workers in the.
The person on this stage is a convicted felon. Is the man I'm looking at right now, and because he indicted me because I was his opponent. I have, I've seen you swing. I know you swing.
Hey, let's
not act like children.
President Trump, we're going to
21
turn.
rounds.
Let's not act like children.
You are a child. Look,
It's brutal, man.
I can't trust Obama. I have read about him, and he's an Arab. He is not.
Racism was real back then still.
No, ma'am. He's a decent family man, citizen that I just happen to have disagreements with on fundamental issues, and that's what this campaign is all about.
That is literally like, I remember when you go back to like the Clinton era, like anything that really bad that would have happened that was unprofessional, like it was such a shrouded mystery. And like, I don't even know if TMZ existed back then, but I can't get over how much I was talking with a few of my clients about this. Like, how has this become the landscape of political debate today in a very like global, it's not just the US. I think there's a lot of countries that are going through this right now. I don't know if I have to share any more clips. I think you guys kind of get the idea of just how did this shit happen? How did we get to this point, people?
I'm pleased to be at the University of Denver. Appreciate their welcome and also the Presidential Commission on these debates. And congratulations to you, Mr. President, on your anniversary. I'm sure this was the most romantic place you could imagine here with me. So congratulations. This is obviously a very tender topic.
do that, you have to be quite smart, and you have to be able to hit the ball a long way. And I do it. He doesn't do it. He can't hit a ball.
I mean, Biden's probably going to step down here. And if you're left with Trump, like, good fucking luck. That's all I got to say. It's going to be another shit show of policy. I've talked about some of the Canadian politics. If you guys want to get a little like clash to hilarity, I saw this video. This is an old one, actually. I think it's quoted here from 2021. But I really wish that this resonated a little bit deeper, because I think when you look at the absolute spending of, there's been a lot of controversy because like Trudeau's been spending like $200,000 just on plane food for his family, like just food on the plane, 200 G's, like more than I'll make in a year. This dude's just ripping it in food on a plane. So this guy comes up and he literally starts listing the expenditures of the government.
My name is Franco Terrazzano. I'm with the Canadian Taxpayers Federation, and I'm here on behalf of 235,000 Canadian taxpayers asking you to spend less. I'm here today to say no more spending $8,800 on a sex toy show in Germany.
This is
No
true.
more racking up nearly 6 figures on fancy airplane food during a week-long trip.
Literally.
No more giving former governors general a $200,000 a year expense account for the rest of their life. No more taking pay raise after pay raise after pay raise while millions of Canadians struggle through a pandemic. No more giving 300,000 bureaucrats a raise while their neighbors lose their job or business. No more giving failing crown corporations like the Bank of Canada millions in bonuses. No more announcing $295 million for the Ford Motor Company, $420 million for Algoma Steel, $12 million for Loblaws.
It goes on and on. Like, I mean, I don't know. I just honestly, like, I just want to bang my head against the wall when it comes to politics. And I'm just shocked that the entire economy hasn't fallen apart, or we haven't got into some crazy like war with some other country because they just see us as being like super weak at this point, especially in the States. Like, you guys can't stand up and be proud of this shit. I don't know how we put up with what's going on today. You know, I'm not going to be the revolutionary, the upriser that starts the whole deal. So, but I just don't. Can we vote? Can we just vote for better? Like, how are we stuck with the options we have today, man? It's just too much. It's just too much. On a positive note, the only thing that I do look forward to, however, is obviously seeing my dividend checks come in and my investment portfolio continue to grow, because I love how agnostic companies are to the societies that they're brought up in. There's a lot of good companies that have come out of a lot of the different places. Some of them are unfortunately being dragged down with certain economies when it's probably lack of deserving, especially when it comes to probably some Chinese companies. But hey, communism with a little bit of a capitalistic quality, you know, still has to deal with some shit. But hey, you know, Kyle, do you see the huge dividend increase on SCHD? Because no, I did not talk about it when I was talking about SCHD in my last video. But yeah, I mean, SCHD is pumping it, baby. You know, I'm not really like overly impressed at all. I honestly, I don't really care. I'm hoping that some of these stocks, I'm buying them for a recovery. I mean, the last declared dividend was 82 cents, which took the yield up to like 4.24%. because it's based off whatever, I think a lot of these are calculated based off whatever the trailing last payment sort of a thing was. But this is miraculously higher than this time last year, right, when we were only getting like, you know, 60 cents. So, I mean, it's a massive, massive increase. But again, like, I honestly think if you're buying SCHD, like, I'm trying to look for companies that over long periods of time have, or ETFs specifically, that have offered a very decent amount of total return, right? And SCHD has just not done that right now. Like I said, I'm not chasing this for a 4% yield. If I wanted a 4% yield or higher, there's so many better investments out there, especially like VDY or just, you know, XDIV. There's so many like really, you know, if you want income, there's just better options. I just don't think, you know, you can still get higher GIC yields and like high interest savings account yields, because I'd have made more money having a high interest savings account investment than I would have owning SCHD basically for the last few years now. I mean, it hasn't done realistically anything. So am I proud of that? No, not particularly. Like, I really don't care about the dividend if the stock hasn't done anything, because I've only made the yield return over this time. And if I was spending it, sure, it's a good place of diversity. But ideally, what I'm looking for here is a recovery once we start seeing interest rate cuts. And I don't mind leaving this as a 25% of my portfolio, because again, if the S&P underperforms, which it did during this period, certain aspects of this period, it gave me some investment capital to reinvest. Especially, I picked up some SCHD shares at some pretty good levels, and I do have some good capital gains on it at this point. Just nothing like the S&P or growth stocks, right? And it hurts when you're missing out on that, when, you know, like, there's been such growth in the markets during this period of lackluster return for these kind of stocks. But again, you're hoping there's some cyclicality to it, right? Like, I'm not just going to give up after the first two and a half years here. Like, I think there's going to be some innings for SCHD and a lot of the lower half of the S&P 500 stocks, because again, we're just sitting in a shitty period where most companies just aren't doing that well outside of the exceptional few. And I don't even know how NVIDIA is like lifting the whole market when most of its revenue is coming off the back of all the major tech companies. It's just sucking value from not you or me, but other big tech. So I think Apple is probably the best resemblance of what the market looks like today. I think Apple and anybody that sells high value products, really, until these companies start kicking it back into gear, I think this is a good resemblance of, hey, like, things have been tough. Like, look at this, really resembles SCHD, if anything. I mean, you look at the flatlining, right? Like, this has happened to most companies. I mean, they hit a peak and the revenues just haven't been doing much, because you can't be selling just really high-end products in a lot of different markets. You look at like Home Depot, right? Like, Home Depot is another great example of this, which is a company that still hasn't been able to recover revenues in this shitty housing market because of higher interest rates. But this is a world-class company, and you just can't help but feel that this is going to turn around at some point. Like, real estate's got to turn around at some point. We just have to be real patient with some of these interest rates, right? So I mean, it's definitely interesting. I started recently investing. I recently started investing. So I missed each of the tech sector and the Mag 7. So I'm investing heavily in REITs, hoping they will go up when interest rates go down. So I talked about this being a very bad perception to have. I get trying to chase, where you think the next best return is going to be. And REITs are super cheap. There's a lot of discounted REITs that have yet to recover that are still trading like double the NAV value. They're still generating almost the same revenues. I get it. I see the same stuff, but you have to recognize that, you're gambling on the future of those returns, right? And you really want to be buying quality, not necessarily just because it's cheap. I see the same thing with like MPW stock a lot. Actually, let me just pull this up real quick for you guys. Like MPW, for example, like this is a REIT that's trading back toward its 2008 levels. There's been a lot of debate on if this medical REIT can recover after a lot of drama that they went through, but the revenues are still, like, their NAV value and the revenues are still well above the current stock trading price. We talk about this with, there's so many, right? Like I like Cap REIT a lot, but Allied Properties is one a lot of people are looking at. Like Cap REIT, I think is almost guaranteed for recovery. They're in a very good sector of the market when it comes to just rental units. Like they'll be fine. They have so much diversity, but a lot of people are looking at like Allied Properties, because they have some office exposure that's been really concerning, and this stock has just been absolutely cratered. And I think they have like 6 or 8 billion in assets, yet their stock trades for like 2 billion, and it's down 73%. But what I wanted to point out was, if you take a look at the S&P 500 the PE history, and the reason that I'm saying that, like, the markets are highly irrational most of the time, and stocks can trade down for eons. Like, look at Alibaba. Some of these companies should just not be trading at the levels they're trading at, but due to perception is reality, these stocks can trade in the gutter for a very long time. And it's kind of that Warren Buffett quote is like, the patience sometimes you have to have is unfathomable, because the rationality, when you watch all these other stocks that will continue to go up against the backdrop of yours not doing anything, starts to get to you mentally, right? So when you look at the S&P, and I pointed this out, that during basically like the peak of the S&P period here, will it show me here? Yeah. The peak of the insanity, right, when it came to price to earnings as of recently, was December of 2020, when the price to earning multiple hit 36 on the S&P 500 before cratering to 20 by June of 2022. So if you take a look from September of 2020, if we just pull up VOO, let's use it as an example. So September of 2020, we don't have to go that far back. So we go back to 2020 here. December, so just at the end of the year, right, we can see that the market wasn't even at an all-time high yet, but this is December of 2020, right? This is where the PE peaked, right? And then all of a sudden the market just kept going up. And then the valuation didn't correct until June, July of 2020, so right here. So during this weird period, the market hit peak price to earnings multiples, then corrected the price to earnings, and all during this time, the market still hit new all-time highs. And it didn't hit an all-time low. Like, it didn't hit an all-time low till like, October of 2022. So like, you have to really understand that even though price to earnings multiples get out of whack, it has no reflection on the actual performance of the price. Because during December of 2022, if you just bought and held on, you'd be up again 48% overall. So I don't like when people just think because these stocks have run a lot that they can't continue to run a lot more. Like, there's so much potential in these mega cap companies that to write them off because I missed the rally. I think you're going to be very sore when you find Microsoft, continuing to post these insane revenue numbers, right? Like, Microsoft is a software business. They have very stable underlying fundamentals, and they're back to where they were post-pandemic. And, they continue to grow at a 15 to 20% clip in revenue year over year. This company is going to continue to go up. Like, it can justify its let's see, like, the price to earnings on this. Where do I go find that? Operating net income. Are they buying shares back too? Yeah. Look how many shares Microsoft is buying back. It looks like they issued some for the first time ever, but that might have been pay packages. But you buy that many shares back, you're giving yourself a guaranteed growth rate. But if you take a look at the price ratios here, there are some concerns, obviously, because their growth rate isn't beyond where it was in the past. So, you can, I can honestly justifying a 38 times. Is that what it's trading at right now? Is Microsoft trading at a 38 times? I don't believe that. Is that true? Okay, it's a little expensive. It's definitely trading at a 38 times. I don't like that at all. Oh shit, it is too. Look at that. Okay, Microsoft's expensive. Could just because of the OpenAI purchase too. I mean, if that thing goes public, there's going to be a lot of value creation for Microsoft. So maybe that's why it's pulling some of that value forward here. But that's expensive. Okay, so we get to see, maybe it deserves to correct a little bit. I think, I don't mind paying it 30 times, but maybe that's a bit expensive. But if you're comparing it to things like Meta, I think Meta is kind of at a reasonable value here at a 29 times multiple. Most of these stocks are. Google, I think, is at a fair value at 28 times. Nvidia is obviously debatable depending on where it goes in the next couple of years. Apple's definitely, I think at a favorable value because I think there will be some growth. 32 times. It started pulling some of the AI growth and the phone upgrades forward. But is it a little expensive today? Probably could correct a bit, but honestly, I wouldn't stop buying. I think not buying these kind of companies, either through the S&P or the Qs, is a sore reality of not understanding how cost averaging works. And I would not just go look where things are just cratered and presume that's where you're going to make your biggest return. It's likely you could get some return out of there, but it's all gambling at the end of the day. It's all gambling and speculating. As soon as somebody tells you they know what's going to happen tomorrow, you just get the fuck out and run because nobody knows what's happening tomorrow. And in tandem to that conversation, we had some pretty good comments. Still holding on to my REITs, hoping for the best. Ha ha ha. I think the biggest players like Rio Canada and Canadian Apartments will be fine long term, but the smaller commercial REITs heavily involved in office space are in real trouble. Sadly, I have smaller positions in some of those and will likely take a bath at some time. At least there is some tax harvesting benefit. I agree with you on your comments about TELUS recently. Very irresponsible to increase the dividend yield. They should pay down their debts before shareholders are diluted. I have some holdings that stubbornly kept dividends high or even increased them when they should. So I like this guy's perspective. And somebody replied saying, I've stayed away from REITs like the plague. People certainly shouldn't be holding them in their TFSAs as you can't write off your losses. There eventually will be a time to hold REITs again when interest rates start going down consistently. In time like these, it's not always wise to be well diversified, especially when certain sectors like this one screams that it isn't the time to hold them in. These are both very good perspectives because if you're buying REITs individually, they haven't done anything. There's going to be a recovery once interest rates cut enough, and there'll be a lagging factor to how that affects their bottom line earnings. So you could probably wait a little bit and try and play it out as a swing trade. But it's a fascinating perspective that, things like TELUS, especially, right? Like, is it appropriate for these companies to be raising their dividends? And a lot of them are in the back. I mean, that's why SCHD's, getting some record yields here, even though a lot of these stocks, they haven't done anything other than increase it. And that's because companies like TELUS, which is continuing to hit, more 52-week lows, and people don't know what's going on or why, because it's not like they're diluting. They're not really doing anything here. And the stock is now down 40% from its peak, with a 7.5% yield, which they can afford. There's a lot of write-downs. They still can afford this yield. But isn't it an appropriate thing for companies like this to be paying out insane, dividends when, they're getting wrecked from interest rates and, they're doing a lot of write-downs. Honestly, I don't think they're in the worst position imaginable, but I'm very interested. You got some people actually acquiring some shares here. It looks like TELUS stock falls Friday, underperforms market. Like I said, I think there's some value in this. I think these companies, if you're patient with them, you just expect to get your total return from the dividend. Even if they cut it 10 or 15%, it's not going to kill anybody when it's 7.5. But again, patience, buy it, hold it, forget it. I mean, that's the way the strategy works with these kind of companies right now. You really just can't get caught up in the irrationality of the short term. VDY is way too overweight in financials. I've been happy to accumulate plenty of shares of the TSX dividend pairs over the past years during the dip. So I actually like this. This is why I buy VDY. It might not be for everybody, obviously, because it is super concentrated in, it's like 50% financials, and Royal Bank and TD make up like 23% of the entire ETF. But I like that because it's not like a huge position in our portfolio. And I like having higher exposure to the bigger banks personally. So for me, it works. Maybe not for everybody, but for me, it definitely works. What's your position on buying VO over VFE? Somebody was asking me this over and over. Why does everyone ask me this? I like native currency. I don't like being forced to convert. If you like buying simpler stocks in Canada, then fine, so be it. I don't know how I have to explain this. It's like I beat my head against the wall. Like, I like US dollars. I can spend US dollars. I have US accounts. I love that Canada lets me make money tax-free in another country and spend it tax-free in this country. I love it. I can't get enough of it. And it makes me feel like truly rich. It makes me feel maniacally, evilly greedy and rich. I'm like, when I can make money and all these other kind of like, even I can even use my accounts to like buy Euro stocks. I could probably buy Hershey in its native currency. And like, the only problem is I don't know. Will they let me open a Euro account here? They might. I've never asked. I only ever focus on US and CAD, but hey, I operate through a multitude of currencies and I love it. And nothing makes you feel more sophisticated than owning a multitude of income sources that are in their own native currency. Feels good, don't it? What do you think about views? What is the views, baby? Let's take a look. The Vanguard US total market. Oh my God, we've got another strongman personal finance in here. Obviously, total stock market is the easiest and smartest thing anybody will ever do with their lives. It's not something I'm as privy to because I always have this itch to want to own some individual stocks, and I like a little bit more concentration than total markets because I still believe tech is going to severely outperform over the next decade as it has in the past decade. And it's nice that this gives you 33% exposure. It's a great ETF. I mean, you know, there's nothing wrong with this by any metric. I would any day of the week if I was just a simple investor, this is the way to go. I mean, if you're not looking for dividend income, you're just looking, you got a job, you don't want to retire tomorrow like most of these influencers are. I mean, by all means, just buy this every paycheck and call it a day and just wipe your hands scot-free. Like I said, for me, I want a bit of outperformance. I try and do a little bit of balancing between the dividend stocks and, tech, though I'm kind of concentrated in Tesla and Meta between me and the wife. I think those are our two biggest positions today. We'll see how it pans out. Meta's been doing pretty good. Tesla, time will tell. We'll see if that was a dumb decision or not, but we'll hold it for a while. Anyone else adding Nike? Yeah, so Nike, I've seen some videos on this already. I honestly don't know enough about Nike. I've talked about this before. I'm a guy that shops at Skechers because it's cheap, it's comfortable. I own Nike shoes, and I always found them to be incredibly uncomfortable shoes that they're better to flip. I sold some Yeezys before. I did some work for some people, and they gave me some Yeezys, and I sold them for like $300 or $400 just before the whole Kanye thing exploded in his face. And my fiance thought I was nuts for selling them. And then after Kanye broke apart, she's like, "Hey, you sold those at a good time." Nike, honestly, like I said, I just don't like these products. I don't like name brand. Let's just take a look on and see how their revenue is doing, because these are the kind of brands that, they start struggling in these market environments because people just need to save their money. It's like Gucci, and they're great businesses. They've done exceptionally well. It's just, man, their growth rates have plummeted. Not plummeted. I mean, Nike's doing fine. They're just flatlining, right? I mean, what's their net income look like these days? Margins, net income. Yeah, their net income has cratered a bit, probably cost, expenditures going up, interest rates, blah, 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 blah. Same story. Is their margin still good? No, margins have come down quite a little bit. Like their operating margins are just garbage. Well, gross margin's good, actually. Look at how much money Nike makes, 44% on gross, but their operating is garbage. They spend a lot of money on operating, which sucks. But yeah, for a company to sell a shoe and make a 44% gross margin is nutty. That's higher than Apple's margins, by the way, except Apple's able to hit 33 gross or bottom. Their bottom and operating margins are like 30%. So Nike's got to get that game back up. They're kind of down a lot from where they peaked back in 2021. That was the hype, though. That's when everyone had helicopter money, right? But yeah, I don't know. What do you think? You like Nike? Are you guys buying it? I just couldn't do it. I like Hershey. I think if I was going to buy a dip on a stock, which I'm glad that I get a little bit of exposure through SCHD, but I really like these companies like Candy that are more addictive. This is like the kids' version of cigarettes. I really like Hershey a lot. It's down 33%. It's paying almost a 3% yield. Let's just take a look at their revenue and see how they're doing, because they've had issues with like prices going up with chocolate and all that, but they've still been able to peak all-time high revenues. They've done an exceptional good job. Look at their net income. Their net income is still at record highs here. Hershey is just one of these companies where I should probably be buying it, honestly. I look at it all the time, and it's always had a special place in my heart because they just own everything. They own Easter, they own Christmas, they own Valentine's, and they literally own our childhood. It's a true monopoly. It's one of the few monopolies that is a true monopoly, and I love it for those reasons. I should buy some of this. This is what I should maybe take a deeper look at. Yeah, I mean, again, a lot less cyclical too, right? I mean, I feel like Hershey's got a little bit more stability behind it, because chocolate, even though it's a bit more expensive. People still buy it. It's like a drug. It's unfortunate. Let's read through a few of your comments here and see what we missed, folks. Dividends for life. I like total return for life, baby. Yeah, I don't love discrepancy stocks or discretionary stocks. Like Lulu as well, but don't think I'd want clothing brands in my portfolio. I mean, didn't Strongman just like rip Walgreens stock apart after like Jeremy was like buying this shit? I mean, Walgreens got wrecked. These are companies got to be a little bit more careful. I like huge name brand companies. Honestly, when you buy hyper quality companies in their sector, you know, back in the day, I thought I was cocky or more arrogant than I am now, I think. But back in the day, I thought, hey, like the way to build the smartest portfolio imaginable if you're buying individual stocks is pick the biggest company in its given sector and just buy that. Buy the 2 to 3 biggest companies in each given sector. Build a portfolio of 20 to 30 stocks of just the 5, 6, whatever sectors, and just pick the biggest players. And what I might do is even just build a practice portfolio around that. Obviously, the index, I like it because it passively, over time, as things change, over the long period of time, those stocks are going to obviously change. But over the last decade, I mean, you look at something like a JP Morgan, right? Absolutely fucking slaughtered. And this is not a tech company. And if you own this for the last decade, being the largest bank, like you've done exceptionally well. Same within the Canadian economy. Like if I just bought the 2 largest banks between US and Canada, my rate of return would have been phenomenal. You buy the best phone stock, Apple stock, boom, you've done exceptionally well. Software, Microsoft. I mean, obviously, even if in the chip market, because NVIDIA has been the largest chip company forever, just if you just bought NVIDIA, like if you just literally focused your investments like that over a decade, you've done so fucking well. So I just hate how people like, again, I like small caps. I feel like they're lottery tickets, but I always feel like people make investing so much harder than it has to be. And they just refuse to focus on quality. They see a chart that's gone up to the right so fucking far and they think it's over. and it just blows my mind. And then they go to persistently pick the worst possible companies and they're super lucky if they recover at all. You know, again, like, Home Depot, like I'm just looking at all these companies and I'm super glad that they're upper weighted in these beautiful passively weighted ETFs. You know, like VOO does an exceptional job at really bringing all those sectors alive and really kind of upper weighting the best ones. Cause that's what VOO has really exceptionally done. Because all those big companies like Johnson & Johnson, Eli Lilly, like a lot of the top 3 players are all at the top of the S&P. You know, Home Depot is still holding up and the 5-year return has been quite exceptional considering it has been getting quite beat up in this market. Hasn't really done anything since 2022. No market return. The dividend's been completely wiped out. But I still think to own a company like this, you're going to do well over the long run. You're not going to get slaughtered. But if you're buying things like MPW, like you're praying to God it comes back. I mean, you just got to be kind of careful what you're doing, right? What do you think of buying Shopify right now and holding it for 5 years? I don't buy software companies as much. I've talked about this before. Like it's the same reason I won't buy Palantir is because nobody can actually explain to me what they do or how it works. I understand how Shopify works, but I am like, the 2 things that bother me most about Shopify is that it's a Canadian tech company that was in a bubble. Unlike the US tech companies, Shopify was actually in a bubble and it had a full burst. And I think that's because the Canadian economy severely lacks diversification in tech companies. So the few tech companies we have are bubbles. Constellation Software, I think, is Constellation back in an all-time high, which is an absolute bubble. I mean, look at Constellation Software. I mean, look at this. This company trades at 106 times its current earnings, and it is just flabbergastingly up a lot this year. Can I see their revenue? Will it come up on macro trends? I've always been hyper concerned about these companies because the revenue is going up, but they're only growing revenue at a 20% clip. And they're doing it mostly through acquisition. Like, how is a company growing, fundamentally, I have a hard time wrapping my head around the values of these Canadian tech companies. They're just absolutely fucking insane. They make NVIDIA look cheap, to be honest. It's like how, right? Shopify, let's take a look at Shopify's revenue real quick. Shopify, for me, like I said, it's probably trading at a better value today. Like their net income is garbage. The revenue is fine. It's just that they pump all their money into Mr. Beast, and they just pump their money into these massive, they just pay out tens, if not hundreds of millions into marketing. And right now there's a big, AI shift happening with websites. You can literally get a website built by clicking a button and having an AI completely generate it. I don't know how much Shopify's integrated that. It's just the space is evolving so quickly and there's so much. I just don't, like I said, for me personally, the biggest upside stock is obviously Tesla to me. I like Meta. I really love Meta stock a lot. Meta is still growing. It actually shows the metrics that Google won't. They have the largest messaging app globally. They have VR that's been crushing fucking Apple's. Honestly, I would look at companies like this, companies that have real moats in big industries that aren't going anywhere anytime soon. You know, Tesla's got major moats, Meta's got major moats, Apple's got major moats. Like Shopify, does it have a moat? Is website building a moat? It's a sticky business. I mean, most people that start their websites don't cancel them and go to another provider. I mean, it's a sticky business for sure. How reliable is it though long term? I have no fucking idea. I'm very bullish U.S. markets. If anything's going to crush the TSX by, yeah, obviously. That's why all my money is pretty much in the U.S., right? Like the Canadian markets make up like 10 to 15%, I think, of our combined portfolios today. Actually, I should check real quick. I'm not going to show you because I don't typically show my fiance's portfolio that much. She's much more of a private person. But yeah, even looking at it on our combined portfolios right like now, I mean, yeah, it's literally like 10% or less. We have very minimal investments in the Canadian economy. What do you think of BNS stock? I love BNS. I love the Canadian banks. Go to Pokemon cards, man. You got to collect them all. Honestly, just buy an equal weight bank ETF. I think these things right now are probably at one of the best trading places of their entire histories. And you really have to believe that the entire Canadian economy is about to collapse on mortgage renewals to not buy these. There's a lot of fear baked into these right now. There's still risk, but they're so fucking awesome. I would just buy them through H-Bank. H-Bank's the best. There's obviously, I think ZEB, the Canadian equal weight bank ETF through BMO, but the fees on it are far too high, whereas I don't think they're charging any fees yet on H-Bank. And the fee when it does get introduced, I think is next month. And it's going to be like, it's going to be a super tiny percentage rating. Yeah. So it's 0% until July 31st. And then it's going to be 0.09%. So not even 0.1% management fee. So you can just literally collect all 5 of the banks or 6 of them or whatever there is here. I think there's 6. Yeah. So there's Royal Bank, Canadian Imperial Bank of Nova Scotia, National Bank of Montreal, and Toronto Dominion. I wouldn't buy one secularly. I think together they are monsters and they are incredible. So I wouldn't buy them individually. If you want to invest in the Mag 7, which 2 would you choose? Right now, if I had to choose 2 of the Mag 7, which Tesla's no longer a part of, sadly, I would gladly pick. I'd pick Meta for sure still. And I'd be stuck. If Microsoft seems a bit expensive right now, I'd probably go with Apple. I still think Apple is probably being underappreciated in this market. I think it's going to have a lot of potential long run. I've always loved Apple, though. I've always had a special place in my heart for Apple. Made some decent change on Apple once upon a time. So, yeah, but honestly, Tesla, I still think has the most upside. I can't wait to see what the fuck happens in the next 3 years because it's such a common conversation I have with family and friends now because so many people own Teslas and just self-driving and getting to experience it. My fiance's uncle just invited me over because on the weekend I was ranting and raving about self-driving. He's like, oh, come drive my car. He's like, I own a Tesla. He's like, I'll only let you drive it if you own shares in Tesla. He's too funny. What's the main benefits of you holding stocks in your holding corporation? Just wondering. So when it comes to corporate investing, there's a few factors to this that are just beautiful. And, I think it's prevalent that everybody either has a corporation, and you don't even have to incorporate to say you're running a small business for write-offs. But there's so much liability safety. I talked to a lawyer recently, and that was the first thing they said. They're like, do you have any of your money in a corporation? I said, yes. Okay. Well, they're like, there's your first level of protection. Because you, as an individual, you can sue me for all my money, but you can't really sue my corporation. Like there's it just separates the liability of your personal stake. If you have a car accident or something, if you're married, depending on what state you're in, obviously Jeff Bezos' wife got a big benefit, but here in Canada, for the most part, if I get a divorce, you just can't get half my corporate money. Like you can't take my corporation's capital, which is great. It's not part of the divorce conversation. Whereas if I do decide to leave money to somebody, it is substantially easier to leave that money in the corporation, right? And I can use the corporation like an RSP. I can avoid a lot of the capital gain taxes and the passive income taxes by paying those gains out when I want them. So I kind of just use it as an RSP. It's a place to make a shit ton of money in my business in a very tax efficient manner. I can spend that money on my permanent residence. I can spend that corporate money on some of my food, my travel expenses, and I don't have to pay any tax on that money because, as many of you know, a corporation earns money, they pay expenses first, and then they pay tax on the money remaining. And in Canada, you only pay 12% on the first $500,000. I can also make money in the US and invest that money from the US in a much more tax efficient manner, because Canada doesn't allow you to charge HST on services or products you're selling to the States. So I only have to pay 12% on all US revenue I generate. There's so many benefits. It's very convoluted, but I would highly recommend starting a corporation and divesting some of your capital. It is honestly, the way I recommend like the steps is max out your TFSA first, RRSP second. You probably want to do both in tandem, because your RRSP gives you tax deductions. Obviously, you get some of that tax you probably paid on your employment income. You get some of that back immediately, which is great. And then you get some obviously tax-free growth. So max those two accounts first. And then the third thing would be to start a business and start investing in a corporation. It'll be the smartest thing you ever do. What are you taxed on that income as a business income or capital gains? So 50%. Capital gains are taxed a little differently, but most of it's taxed as passive income. There's a lot of exceptions for Canadian dividend stocks. Sometimes if you get a Canadian dividend from a Canadian stock like company, sometimes the government just waives the tax on it altogether. It's really convoluted and weird. They're just like, hey, they're just Canadian corporations changing money essentially. And because Canadians are already paying taxes on the dividends that they're paying out to another corporation, the government sometimes just waives it, which is interesting. It's really weird. But for the most part, you're taxed at a 50% tax rate, which is insane. Not an inclusion rate, a 50% tax rate. There's something called passive income tax here in Canada, which I'll show you real quick. Passive income tax on corporations. Yeah, it's a huge percentage, and this is what scares people off from investing. But honestly, you just need a good accountant. So passive income has a tax rate of close to 50%. With active income, the first 500,000 earned by a Canadian-controlled private corporation has a lower tax rate of 9 to 12%. So in Canada, unlike your personal income, where if you get over 50 or 60,000, you're paying out like 40% of your income. In a corporation, you're paying only 9 to 12% on the first $500,000 earned. However, if you are buying investments that are considered passive, so if you're buying stocks and you're not trading them, which again, if you want to be very convoluted, you can sell your stocks at the end of the year and then immediately buy them back. Do that kind of weird, like wash your hands free, where you sell like a VOO and you buy SPY. You just buy the same investments, but another counterpart. And then you can say that you're actively trading stocks within a year and it's not considered passive income. And if you ever decide to pull gains out, you can always pull your gains out and it's just regular income. It's not really taxed at this crazy fucking way of 50%. It would be just taxed as your regular corporate income. So you'd pay 9 to 12%. However, keep in mind that if you pay out this active income, which is why a lot of corporations do, like REITs, that's why like a lot of them are obliged to pay out such a huge percentage of their income, is because it completely waives the tax. So, I mean, if you want to avoid paying like any income tax, you just say, hey, like, this is why it's better to own capital growth stocks than it is dividend stocks in a corporation, because then you have control over the gains. So in the future, if I lose my job and I want to start paying myself out the money and like I'm up 30% or whatever in the S&P 500, I would just sell maybe 10,000 worth and then immediately pay it out to myself. And then I would only be obliged to pay taxes on my personal income, and the corporation completely waives the passive income tax. Like I said, it's fucking complicated. It makes no fucking sense, but I'm promising you it's worth it. I've done it for long enough now, and I've been through 3 different accountants since I've been doing this over the last pretty much the entirety of my life. I mean, I've only had a corporate investment account for the last 4 years, but I've been self-employed for like the last 15 years of my life. So if you have room in your RSP, do you invest in what are you talking about? Do you have room in your RSP? Do you not invest in a corp? I'm not sure what you mean by that. Honestly, if I have contribution room in my RSP, which I did this year, I took money out of my corporation to fill up my RSP because the tax will be waived either way. I would always max my RSP first. RSP and TFSA are the 2 most fundamental ways to get rich in Canada. And the only reason you want to run a corporation is to completely evade paying taxes on so many different things. And not evade. Like I said, I pay my tax. I have employment income. I literally have a full-time salary job where I pay taxes. And then I have part-time work and this YouTube channel that makes its own revenue and whatever that I use for my corporate income. So it's just to sever things off. But like I said, I should do a course on it or something, but I feel like I would not do it justice and I'd have to bring my accountant on to make sense of it. But anyways, folks, do you ever swing trade or just only pick long term? No, like it depends on if my opinion changes. Honestly, I consider most of the money I've ever made in the market to be swing trades. And a swing trade to me is 3 to 5 years. I think long-term investing is 5-10 years plus. Swing trading is anywhere from 1 to 3 to 5 years. And most of the money I've made off Tesla, Apple, MindMed, Canopy Growth Corp, all of those major trades came within 3 to 5 years. I buy the stocks, I sit on them for a while, and then I sold them with no intent of having, because my opinion changed. Like Google, I bought Google and I sold it at an 18% gain. I think if I held it longer, I'd have made more, but my opinion changed. I'm concerned about their fundamental business. But no, I prefer not to. I like long-term investing these days. Do you like BAC? Yeah, Bank of America is pretty great. Yeah, honestly, I've met people. I was talking to a guy yesterday I met that was a day trader, and he was just trading the Dow and that stuff. But yeah, I don't know. I'm not a big trader, to be honest. I'm sure by the time your TFSA and RSP are maxed out to the point you need to start a corp, you are already paying more tax than 90% of the population. Yeah, maybe. I mean, most younger people, I mean, because you only can start contributing to your TFSA once you hit, 19? And that's when it starts to accumulate year over year. You just don't have like a huge amount of contribution room either. But yeah, I mean, yeah, if you have the ability to max those accounts out every year, yeah, obviously you're probably paying your fair share. I mean, let's be real. Explain how the RSP work in the contribution room compared. Oh, baby. Okay. I don't want to bore you guys, but I'll do this real quick for you just as a personal favor because Google can easily do this for you, sir. But basically the way it works is an RSP, the Registered Retirement Savings Plan, basically allows you to take money that you've earned, that you have paid tax on, to put it within this account to defer the taxes. So you paid your 20%, let's say, on the money that you earned. You put that into your TFS or your RSP, and the government says, hey, we see what you're doing here. We're going to give you that tax money back because you're deferring that tax into the future. Now it's in this tax sheltered account where you can make money tax-free in perpetuity for as long as it's in this account, or at least until you're 65, because unfortunately at 65, you do have to start pulling the money out of this account by law. But you have all those years to tax-free grow money without paying any tax on any gains or any dividends in the US or Canada. However, when you pull that money out, that's when you start getting taxed. However, you're only getting taxed at your marginal rate. So let's say you're in a really high income tax bracket, you're crushing it, you're making $100K a year. It's probably smart because I think it's something like 10% of your net income a year you're allowed to put in your TFSA. I think it's a bit more than that. So you can take that upper percentile margin, which let's say it's 10 grand, and you can wipe off and save yourself probably 40%, 50% in taxes. So you'll get 4 grand back. So you got 10 grand to invest, and then you got an immediate 4 grand return on your taxes. You made a 40% return on your money instantly, and now you can grow it tax-free. That's like the beauty of how that works, right? Sorry, that might have been a bit convoluted because the 4 grand you're getting back is what you would have paid on the 10,000 that you put in that account. If you already paid tax on it, you will get a tax refund. So at the end of the year, it's a beautiful fucking system. The TFSA is the ultimate of all accounts. It is your bread and butter. It is your tax-free forever for all of eternity fucking awesomeness, because basically any money you put in here, you've already paid tax on. Not like the RSP. No. You pay tax on this money, and the government says, hey, we're going to let you put that already taxed money in this account. You can make tax-free dividends, tax-free growth. If you buy U.S. dividend stocks, however, we're going to charge you 15% over-the-border withholding, which they don't do in the RSP. I don't know why that is, but it is what it is. But you can now draw those dividends. You can draw those capital gains tax-free whenever you want from that account to spend personally, tax-free, and it does not affect your income tax bracket. So let's say you're making $100K a year, you've maxed out your TFSA, you have $100K in your TFSA, and that TFSA is making 5% a year in dividends. You're cash flowing $5K a year. On top of the 100 grand you're already making at your job. Now you can pull that extra 5 grand out. Every single year you want to pull it out, you'll never pay tax on it. It won't affect your income rate. It doesn't raise your bracket, and it's just there for whenever you want it. So that's kind of the variables between those two accounts. They're fucking awesome, bro. Like, it bothers me how stupid our education system is. They don't teach you this. Like, I just wish, like, imagine being 18 years old or 16 or even 12, and they're like, hey, you want to make money without ever paying tax in perpetuity for the rest of your life? Look around you. You can own the hydro company. You can own, if you have 10 grand to invest, not even 10 grand, you go put it in TELUS right now, you'll be making like 7.5% yield. It'll pay for the rest of your life, your phone bill. $10,000, you're going to make $750 a year. My cell phone bill is like $300 a year. It's like I could literally pay the entirety of my phone bill in perpetuity for the rest of my life with a $10,000 investment, not even, probably like a $7,000 investment. You know how crazy that is? To, if you like, I wish I had that epiphany at like 10 years old. My life would be so much better. It's like, it's such an insane concept to wrap your head around. I hold in a savings account. Anyways, folks, I'm going to stop rambling here. It's a pleasure. I can't get over. I've just been rambling for an hour. I took like a fucking hour nap before I started this. Oh man, I almost slept through the stream, man. I hope you guys enjoyed it. I made it. I made it. I'm such an old dude now. I sleep on Saturdays. You know, yeah, you got that 15%. It's you know, it's the give and take. It's the give and take. Sometimes you got to give 15%. Let's stay cool. Stay awesome, folks. Peace out.